This conference will now be recorded.
Hey everybody, just wanted to say welcome. Thanks for coming. And we will get started here in just a few minutes.
Good morning, everybody.
Good morning.
Matt, it looks like we got 2 more minutes left. We want to wait, give people 2 minutes to log on and then just go ahead and start.
Yeah, that sounds good.
Okay.
Morning, Daniel. It's like we got a couple more people joining.
Think we can go ahead and get started, Matt?
Yeah, I would. Let's go ahead and get started. People can join in kind of as we go.
Yeah, sounds good. Hello, everyone. Good morning. My name is Dave Dobbins, and as you can see, Matt Fuller. We are with the Fitzpatrick Group. So, first, let me say thank you to everyone for joining us today. What we're going to be talking about is some things you've probably never heard of before with regards to financial conversations. So we're with the Fitzpatrick Group, like I said, and we are a full service financial firm. And we focus primarily on retirement, and more specifically, we focus on a tax advantaged or 0% retirement, 0% tax bracket in retirement. And we have a very specific strategy, and we have very specific ways that we go about doing that. But primarily, our goal is to educate our clients on how these retirement accounts really work, to kind of show the math behind everything, and kind of open people's eyes to, what they're actually doing with their money. So, Matt, do you have anything you'd like to add?
No, I think that sums up the kind of what we do in general in a good way.
Excellent. So I'm going to dive into it just a little bit, and just kind of have just a brief conversation about the 50,000-foot view of what our strategy is and how we go about doing that. So we do a lot of these lunch and learns. We've actually been at Abbey live before all this started, and we did a quick presentation there. And anytime I do these presentations, if I stand in front of a room of people and say, most of America has what we call the retail portfolio, is put in place for their retirement. And what do I mean by a retail portfolio? So in 1978, there was a thing called the Tax Revenue Act that Congress rolled out. And that's basically where your qualified accounts were born, right? So your 401k, your traditional IRAs, things like that were born out of this 1978 Tax Revenue Act. Now, notice that it's not called the 1978 Let Me Help You with Your Retirement Act. It is the Tax Revenue Act. So the intent was the government wanted a way to produce an ever-increasing stream of income that they could tax in the future. That way they had some inkling of what kind of tax revenues they would be getting from a certain portion of the segment of the population. And that would allow them to spend more today, right? Because knowing that they've got these dollars tucked away somewhere that they can tax in the future, they can go ahead and spend today. And all they have to do is pull that tax lever, increase the tax rates, and they have their money that they're spending, right? So how did they do that? They said, well, we're going to give you a tax break, you W-2 workers, if you put money into one of these qualified accounts, right? You can take the tax write-off this year. And then what we'll do is we'll just go ahead and let you put that money to work for you. It'll grow deferred, and you can just pay us later in the tax bill, right? Now, it's funny to me because in any other transaction in life, really, if someone were to say, hey, I'll give you this right now, you just pay me for it later, and you say, okay, that sounds great. How much am I going to pay later? And they say, we'll tell you later. Nowhere else would you ever accept that deal, right? But we do it all the time in our retirement accounts, and that's probably one of the most important accounts that we have, right? We're counting on that money to live during a time when we're not going to be able to go out and make more money, yet we're willing to just take a small tax break today and say, oh, I'll pay you later. How much am I going to owe you later? Well, I will figure that out later, right? But we do that all the time. Now, your employer was encouraged to contribute to these plans in the 401k because they were able to get a tax write-off as well. So now here we are in the 70s, and everyone's saying, take advantage of the free money, take advantage of the free money. And that was great back in the 70s because most people had a pension, right? They had, and this 401k thing was like side money that they could just take advantage for free money. Well, then the 80s came rolling around, and Congress allowed companies to bankrupt out of their pension obligations, right? So it started with the airlines, where the airlines could file for bankruptcy, and then they no longer owed those employees that had a pension. They could just wipe it all away. The rest of corporate America was, saw this happening and said, what, you can do that? So pensions pretty much died in the 80s. And now, by default, most of America is left with the 401k as their sole vehicle for retirement. It was never built for that. It was never designed for that. It was designed to be an ever-increasing revenue stream for the government, and a tax write-off for your employer. And that still stands today. But that's one of the major components of what I said earlier about the retail portfolio. So whenever I talk to a group of people, I can nail about 90% of the room when I say we have some combination of this retail portfolio, right? So that's a traditional IRA, right? Maybe an old 401k from a previous job that got rolled over or something like that. Your 401k at your current W-2 job. Maybe you've got some money in the stock market in a TD Ameritrade account or something like that. If you're lucky, you have a pension. There's not a lot of those left anymore, but they still exist. Or you have some real estate, something like that, and then you have Social Security, right? So the majority of America is living on some combination of those types of accounts in order to get themselves through retirement, right? And I probably nailed a portion of the people watching this webinar right now, a good portion, that you have some combination of those things or nothing at all. That's 90% of America. So let's look at that, right? What happens when you get out into retirement? Because that's what we focus on, is the actual distribution of that money. When you get to retirement and you go to start spending that money, what does it actually look like, right? And there's not a lot of people spending time on that. So let's take just a real brief look at that. So in your traditional IRA, anything that comes out of there is taxed at ordinary income rate. In your 401k, anything that comes out of there during retirement is taxed at ordinary income rates as well. If you do have any stock market, so Ameritrade, Charles Schwab, whatever, then that's going to be subject to long-term or short-term capital gains tax. If you do have a pension, anything that comes to you from your pension will be ordinary income tax. If you have real estate, the appreciation on the capital property is going to be capital gains tax. Any income that you have from rentals will be taxed at ordinary income. And then your Social Security, right? So now, because you've shown income from these four sources, if that income is larger than $44,000, Social Security has this thing called provisional means testing. And that says that if you make more than $44,000, you have the means to pay us more in taxes. The way they assess that is now up to 85% of your benefit in Social Security now becomes taxable as ordinary income. So let's look at that. All the dollars that you spend in retirement, ordinary income tax, short-term, long-term capital gains tax, ordinary income tax, and short-term, long-term capital gains tax, and then ordinary income tax. That's a problem, right? You are 100% in bed with the IRS during retirement, paying taxes on money, in often cases, money you've already paid taxes on, specifically in Social Security. When Social Security leaves your paycheck, it's already taxed at ordinary income tax. You're putting after-tax dollars into your Social Security. And then when you get it back, you're getting taxed again on that same dollar. Back in the 1700s, we were setting ships on fire and throwing crates in the harbor over a silly little tax on tea. Yet here we are as a nation getting blatantly double taxed and no one's even talking about it. And that's a problem, right? So how do we fix that? We put people into what's called the ideal portfolio. And the ideal portfolio is built for distribution, most specifically for tax efficient distribution in retirement. It's built so that all the money that you put into these things comes back out to you and you don't sign up to give a big chunk of it back to the IRS. So what is the ideal portfolio? Quite simply, it's an investment grade life insurance, right? And we tell our clients with investment grade life insurance, be careful. There's 100 different companies out there selling 100 different products. Some of it is investment grade, some of it is good, but most of it is just garbage. And I wouldn't touch it with a 10-foot pole, and I'd advise you leave it alone as well. Then we have municipal bonds, right? Later on in life, any of the yield on municipal bonds is tax exempt. We have Roth elections. Anything that comes out Roth, we either have Roth 401ks, Roth IRAs, or backdoor Roth if you don't qualify for either of those two things. And then individual stocks, right? We believe that the stock market is one of the few places where you can realize outsized gains. So we say participate, but participate in a smart way. Just don't asset allocate 100% of your resources to the stock market. And when you do allocate resources to the stock market, follow what people who know how to do it do. When Warren Buffett buys stocks, He doesn't go out and buy mutual funds, so why should you? He's not out buying ETFs. He buys individual equity in individual companies. He buys individual securities, and that's what we do too. I'll tell you right now, he also doesn't have someone at Merrill Lynch charging him 1.5% to manage his money. He buys on a transactional basis, pays for the transaction, and then pays for the transaction when he sells it. And Warren Buffett doesn't really sell that often, but he's a long-term buy and hold investor. And we agree with that philosophy, right? And now you've got Social Security. So let's take a look at how this distributes in retirement. So if you've got investment grade life insurance, anything that comes out of there is tax exempt. Anything that comes out of your Roth elections is tax exempt. The yield on your municipal bonds is tax exempt. In retirement, when we start spending our money out of our stock market gains, we spend below our standard deduction in retirement. We wash that tax bill down to zero. And now guess what? Because we show zero income in retirement, 100% of our Social Security comes to us tax exempt, right? Oh, by the way, you also get a much better rate on your Medicare because you've now passed that means testing. So tax exempt, tax exempt, tax exempt. You do have short-term, long-term capital gains that we wash down to zero and then tax exempt. So you could potentially live off of 100,000 out of your investment grade life insurance, 100,000 out of your Roth elections, 10,000 out of your muni bonds, 10,000 out of your stock. Now you're living off of $220,000 in retirement, yet you're in the 0% tax bracket. You still qualify for food stamps, Obama phones, Obamacare, whatever you got the guts to apply for. The whole idea is the power in your distribution is what's really going to have a major effect on your retirement. And if you have a smart plan on distribution while you're saving, then you can save more efficiently and you can reach your retirement goals with a significantly smaller amount of money. Or on the other side of that coin, come close to doubling the output of what you've already got. So that's kind of what we focus on, right? The 50,000-foot view. Our goal is to get everyone as close to that 0% tax bracket as possible. Now, is it easy to do? No. There's a lot of moving parts. There's the kitchen sink. Some people have assets already that you just can't do anything about it. You're already married to the IRS. But if you're not striving to control that tax burn in retirement, then you're just signing yourself up to assign a lot of that money that you've worked so hard to save away to other people, right? So talking about distribution, Matt's got a quick presentation that kind of helps show it a little bit more mathematically, and it's a little bit easier to understand. So Matt, if you're ready, you can go ahead and show us what it looks like when we get into distribution. Does anyone have any questions so far?
Okay, I'm going to share my screen, guys. So hopefully, let me know if you can't see it for some reason. Let's see, start. Okay, so guys, everything we do at our firm, anyways, is really based in mathematics, and we like to show the clients the math that we use. So we're going to do kind of a basic, pretty brief little presentation here, just to show you guys what we're talking about. Okay, so imagine, and I think Dave hinted at this earlier, that you're climbing a mountain, right? You're standing here at the bottom of the mountain and you're climbing this mountain, right? And think of this as kind of like our retirement mountain. When we say save for retirement, the saving aspect is like going up the mountain. This is what we call our accumulation phase, okay? And a typical financial advisor is going to tell you, we need to make this mountain as big as possible. We need to save as much as we possibly can so that when we get to retirement, the mountain's big enough for it to last basically all the way down. So we get all the way up this mountain, we plant our flag, our little retirement flag, and then what? Well, most people don't really know what then what looks like until you go sit down and talk to somebody, right? But we call this downside here, this backside, the distribution phase or the spending phase. And this is the most important part that you need to plan for. Because while getting to the top of the mountain is important, it's more important to make it all the way down safely, okay? So we're gonna look at this distribution side right here, and we're gonna say, let's take a focus on the distribution angle. So according to the IRS, your money can live in 3 buckets, okay? So your money can live in 3 buckets in the distribution phase. And I'm gonna kind of simply name them. There's the always tax bucket, the sometimes tax bucket, and the never tax bucket. Okay, so let's kind of dive in and talk about what each of these buckets represents. The always tax bucket, money goes in before taxes, and because we haven't paid taxes on it, it comes out 100% taxable. And most of us are familiar with these. These are your 401ks, your traditional IRAs, your SEPs, your simples, and even a pension would fall in here. Okay, so these are what we call basically our qualified accounts. You don't pay taxes on the front end, but it's 100% taxable on the way out. Okay. Second bucket, the sometimes tax bucket. This money goes in after tax, and it comes out with a special brand of tax called capital gains taxes. Okay, now capital gains taxes can either be short-term or they can be long-term. If it's short-term, you might as well throw them back in that original bucket. It's taxed at your ordinary income tax bracket, okay? If it's long-term, it's gonna be anywhere from 15 to 20% depending on whatever taxable income you have for that given year. Okay, these are things like your brokerage accounts, which hold stocks, most bonds, mutual funds, things like that. You could throw real estate that you sell in there for the appreciation on the properties as capital gains taxing. Okay, and then we have the never tax bucket. The never tax bucket goes in after tax, and it comes out what we call tax exempt or tax free. All right, there's really only three ways into this, and Dave already mentioned all three of them. There is investment grade life insurance, which we abbreviate IGLI. Okay, again, there's great, good, and garbage. You want to only go to the great or it's not worth it. Okay, there's Roth elections. So again, Roth IRAs, the problem is they have constrictions on who can actually contribute to a Roth IRA. So if you outqualify that, then you got to look at other options like Roth conversions. If you have a Roth 401k, things like that. But Roths are excellent tools. And then the last thing that he talked about were municipal bonds. They're federal tax free, and because we live in Texas, there's no state income tax on them either. So those are the three that are tax exempt, tax free. All right, so let's put a little bit of math to it. Let's make it all kind of relative. Let's say I wanted to pull $80,000 out of bucket one. Okay, $80,000. Well, assuming it's a SEP IRA, a 401k, whatever it is, we're going to have to give some money to the IRS because we haven't paid taxes yet, right? So let's be nice and let's say you're in the 20% tax bracket. There isn't one, but we're just going to keep it low for this purpose. So we're going to give 20% to the IRS. That is $16,000 you're paying in taxes, which means you get to keep $64,000 to spend. Pretty straightforward. Most of us are pretty familiar with that concept. You pay taxes, you get less, right? But now what I want to look at is what happens to Social Security when you do that, okay? The typical married couple will expect around $50,000 in Social Security, all right? That provisional means testing that Dave was talking about, if you show more than $44,000, so look, we show $80,000 on our tax return, okay? If you show more than $44,000, the IRS is going to take 85% of that 50,000, which is 42.5. Okay, and they're going to tax that at your income level. Okay, so we put you in the 20% tax bracket, so we're going to give 20% of that to the IRS. So that is $8,500 going back to the IRS. So out of that 50, you pay 85 in taxes. You're going to take home about 41.5 to spend. Okay, and again, that's a double taxation. That's what he was talking about. And then we want to look at Medicare. When you turn 65 and you go to apply for Medicare, they determine your Medicare premium based upon taxable income. We showed 80,000. It's more than that 44,000. Therefore, they're going to charge you the maximum premium possible that they can for Medicare, which right now is about $12,000 for a married couple. So we add all this up. We have the 64,000, the 41.5. We take away the 12. And it's 93,500 total that you can live on out of that. Not bad, right? We took out 80 from our bucket, we added some Social Security, some Medicare, and we get 93,500. The problem here is that we're being double taxed on Social Security, and it's really creating a problem for those people that are in retirement that don't understand how the game works, right? I'm gonna pass over the middle bucket for now, and I'm gonna go to the third bucket just to prove the point, because the middle bucket's gonna lie right in between the two. So let's take the same 80,000 out of the third bucket, okay? again, this one goes in after tax, but it comes out tax exempt, meaning nothing goes to the IRS, meaning you keep your full $80,000 to spend. Pretty straightforward. If it's tax exempt, you're not going to pay taxes and distribution, right? Social Security, you're expecting that same $50,000 Social Security check. Because we showed 0 on our tax return, okay, the IRS says, well, you don't have the means to pay more taxes. Therefore, nothing goes to the IRS, and you keep your full $50,000 to spend, okay? Now, Medicare, nothing's, well, at least Medicare isn't free, not the good stuff. So they're not going to charge you the full premium, but because you showed nothing on your tax return, they're going to charge you the least amount of premium possible, which right now for a married couple, again, is about $2,000. Okay, so we add that up. 80 and 50 is 130 minus the 2. That is $128,000 total that you get to spend. Now, a very loaded question, and we ask it for a reason, is where would you rather be, bucket 1 or bucket 3? Well, the reality is, we understand there's some assumptions here, and it looks better bucket 3, obviously, but I want to drive the point home. I'm going to draw a line through here, okay? Everything above that line, most people we talk to have a pretty basic understanding of how that works. If it's going to be taxed, you're going to get less. If it's not, you'll get the same amount, and so on, okay? But pay attention to what's below this line, okay? I'm going to use a different color here. Look at the difference here is $8,500, right? Look at the difference here. That is $10,000. We add those up. That is $18,500 per year that you're willingly giving up. So if you live for even 20 years in retirement, that is $370,000 that you are willingly giving back up to the IRS. Okay, simply based upon where your money sits, right? So if you don't understand where your money sits, then you are being double taxed on Social Security, being charged more for Medicare, and it's literally costing you hundreds of thousands of dollars that you don't need to be paying. And the reality is we were really nice here. I only put you in a 20% tax bracket. The numbers look even worse if we start taxing people appropriately when we look at different situations. Okay. Are there any questions so far about any of this? Okay. Let me get back out of here. Stop. There we go. So guys, actually exit out. Hold on one sec. Okay. There we are. So guys, this is really what we do. We talk to people about tax rates. And if you really ask yourself the question, what do you think taxes are going to do in the future? What's the realistic answer there? I'm pretty confident in saying I don't think they're going down, right? And they're most likely going up. And so when we start looking at the taxation and the distribution, and you combine that with other things like advisory fees that are completely unnecessary in a lot of cases, and then volatility in the market, which we kind of just experienced, it's a pretty eye-opening scenario on what people are really facing in retirement. Dave, you have anything to add to that?
Yeah, really, again, just to kind of reiterate, the three things that we focus on most is diversifying away from taxation, diversifying away from volatility, and Matt kind of just touched on that. We're experiencing a lot of volatility right now. The common saying in the financial world is, if you're a long-term investor, short-term volatility shouldn't matter. The market will eventually come back and you'll be made whole and you won't have lost any money, which is true. But what you really do lose in that scenario is time. And in the compound interest equation, time is the most important factor. And it's the one thing that we can never make more of. If you need to make more money, go out and get another job and make more money. But if you need to make more time, you're out of luck, right? So we spend a lot of time teaching people about how volatility affects that timeline and how once you get knocked off that curve, it's almost impossible to get back on using conventional financial advisory. And then Matt touched again, financial advisory fees, right? We seek to get paid by anyone but you. it's not necessarily in your best interest for us to be taking 1 to 1.5% of your total portfolio value every year just because we bought you some stocks 10 years ago, right? So we take a little bit different approach. So those are the things that we really focus on. At this point, we open up the floor to anyone who has any questions, anything that we may have touched on that you want more detail about, or anything that we haven't touched on that you may kind of have a burning question in the back of your mind, always wondered about something. Take the opportunity to ask one of us live. We're happy to answer those questions. And then also, the goal of today is for us to set meetings with you to discuss how these strategies can affect your personal situation. So if you have any questions that are specifically around your personal situation, Matt and I will be reaching out to you after the seminar. I urge you to set a meeting and find out. All of our consultations are free. Just take a little bit of time for us to find out a little bit about your situation, and then we can kind of steer you in the right direction and see if this is something that would interest you to learn more about. So that's pretty much all I have.
Yep. Does anybody have any questions they want to ask with the group setting? Or I believe Dave in the chat put our phone numbers on there. You're welcome to reach out that way as well. And we will send a follow-up email. So if you have any questions for the group setting, feel free to ask. But that's all of our end of the presentation.
Thank you very much, everyone, for coming and joining us. We will be reaching out to you today and tomorrow. If you would like to set a meeting, please do so, and have a great afternoon.
Thanks for joining.
Thank you.
Thank you.